Let us understand concept of international branch. Say our company is in a country of India. We are having head office in India. We are having all registrations in India. And we are having branch at US. This branch will be regarded as international. As our registration is in India, head office is in India, our reporting currency or local currency will be Indian rupees. And as we are having branch at USA, there will be some transactions which are done in US dollars. So US dollar will be regarded as foreign currency. So international branch, reporting currency and foreign currency. Next portion that we are going to learn is, if we are having an international branch, we will have to decide whether it is integral foreign operation or non-integral foreign operation. Sir, why we need to decide? Because ultimately, when we will convert our foreign currency into our reporting currency, again, why we need to convert it? Because when we will consolidate our balance sheet, when we will be preparing our whole balance sheet, whole company's balance sheet, we will have to take assets, liabilities, purchase, sales, everything of this USA branch, and that is denominated in US dollars. So we will have to convert that US dollar into Indian rupees. So number one, conversion is required to prepare a consolidated balance sheet. At the time of conversion, the rules and regulations of accounting standard 11 will apply. And at that time, you will have to decide whether it is integral foreign operations or non-integral foreign operations, because a rule for conversion of your foreign currency into local currency or reporting currency depends whether your operations is integral foreign operations or non-integral foreign operations. You are going to learn this topic in detail in AS 11. I am covering the points which are important to solve the questions of branch or international branch. Integral foreign operations basically means branch is just extension of our business. Say, let me take a simple example. We are having a car manufacturing unit in India. Cars are manufactured in India. Everything is done in India. But to sell our goods in USA, we are opening a branch in USA. The USA branch will be importing the car from India and then it will be selling it in USA. It is just an extension, integral part of our original business, and so it is termed as integral foreign operations. How non-integral foreign operations is defined? The foreign operations which are not integral. Foreign operations will be non-integral foreign operations. So to run your business, to do some activity in other country, if you are opening a branch, that branch will be termed as integral foreign operations branch. We have already learned the concept of reporting currency and foreign currency. See, foreign currency in our case, in our example, is US dollar. Say fixed asset at our USA branch is $10,000. when you are preparing a consolidated financial statement, your consolidated balance sheet, you will have to convert this fixed asset into Indian rupees because our reporting currency is rupees. So you cannot write down in Indian consolidated balance sheet something in dollars. So you will have to convert this dollar into rupees. Here, where there is exchange rate comes into picture. Say today's exchange rate is 78 rupees per dollar. Basically means $1 is equal to 78 rupees. We are going to learn some types of exchange rate like transaction date rate, so we are writing books of accounts from 1/4/2021 to 31st March 2022. There is some purchase which were done on 1/10/21, 1st October 21. On that date, the dollar rate was 75 rupees per dollar. For this transaction, this is transaction date rate. The rate when the transaction happened, that is on 1st October. So rate on 1st October will be regarded as a transaction date rate. Another is closing rate. Closing rate for our financial year will be rate as on 31st March 2022. Say the rate is 79 rupees per dollar. Then 79 rupees per dollar will be closing rate. Will be important because we are preparing balance sheet as on 31st March 2022. A consolidated balance sheet where we will have to incorporate the figures of USA branch. So it is 79 rupees, that is closing rate. Opening rate, it is rate of dollar as on 1st April 21. Say it was 74 rupees per dollar. Then opening rate will be treated as 74 rupees per dollar. So all purchase sales normally are recorded at transaction date. But understand, in academics, they cannot quote a rate of 365 days. So what we can do is, for making it easy, instead of transaction date rate, we can take average rate. So average rate of all 365 days might be given, or you may take opening rate plus closing rate divided by 2 as an average rate. So instead of transaction date rate, we might take in some situation average rate. Even AS 11 permits, if the rate is not much fluctuating, you may take average rate. So this is a transaction date, closing rate, average rate, opening rate. Points will be important when we convert our foreign branch trial balance into Indian rupees. Next and most important is monetary items and non-monetary items. Why the difference is important? Again, at the time of conversion, monetary items are converted at a different rate and non-monetary items are converted at a different rate. So we need to understand difference between monetary items and non-monetary items. Let us understand simple definition of monetary items. Monetary items are cash or assets or liability which are receivable or payable. As if it is asset, it will be receivable, and if it is liability, it will be payable. into a fixed or determinable amount. See, what does this mean? If I am having debtors of $1,000, it is receivable. Exactly how much rupees? $1,000. Then this debtors will be regarded as monetary item. Similarly, creditors will be monetary item. Cash and bank will be monetary item because it is a determinable amount. Fixed deposit is a monetary item. But say fixed asset is $100. If fixed asset is $100, the amount is receivable. If you sell this fixed asset, you will be getting exactly $100. No. You will receive money, but it is not a fixed and determinable amount. Fixed asset is not a monetary item. So monetary item and non-monetary item is very easy. Non-monetary items, they are items which are not monetary. So you'll just have to decide whether, of course, fixed asset will come over here. So you'll just have to decide whether the item is monetary or not. It will be helpful for valuation purpose. As we have understood, we will be having branch at USA. They will be preparing trial balance in US dollars, and to prepare a consolidated final accounts or consolidated balance sheet, we will have to convert this trial balance into Indian rupees. So all figures of trial balance from US dollar should be converted into Indian rupees. The point is, which rate should be used to convert US dollar into Indian rupees? So should we use opening rate, average rate, closing rate? Which rate should be used? For that, we will have to refer to AS 11, which says your rate will be determined whether they are integral foreign operations or non-integral foreign operations. Initial recognition in any case, whether it is integral foreign operations or non-integral foreign operations, it will be transaction rate. So when you are converting purchase, the sales, all incomes and your expenditures, it will be transaction date rate. As far as monetary items are concerned, what are monetary items? Debtors, creditors, outstanding expenses. Whether it is integral or non-integral, what is used is closing rate. When it is non-monetary items, what are non-monetary items? Let us take one example, fixed asset. In the case of non-monetary items, if they are non-integral foreign operations, the rate used is closing rate. So whether monetary items or non-monetary items, in non-integral foreign operations, what is used is closing rate. But as far as integral foreign operations, non-monetary items are concerned, like fixed asset, the rate used will be transaction date rate. If a fixed asset are revalued, that transaction date or revaluation date rate. Practically transaction date rate. Fixed asset, depreciation, all the things will be converted at a transaction date rate and not at a closing rate, even if fixed assets are valued as on 31st March. Closing date will not be used, in which case non-monetary items, and it should be integral foreign operation. So I changed the color because there is difference only over here. You need to differentiate between monetary, non-monetary, integral, non-integral. Just because of integral foreign operations, non-monetary items are valued at or converted at transaction rate. Contingent liability are recorded at closing rate. So all incomes and expenditures at transaction date rate. Practically, it is not possible in question, in theoretical life, to give you all 365 days rate. So this can be also done at average rate. What will be given in academic question will be always average rate, and I can use average rate for initial recognition, and income and expenditure, I will be taking average rate. Why we are learning all this? There is only one important point, that is integral foreign operations, non-monetary items are valued at a transaction date rate instead of closing rate. Otherwise, the points are simple. We need to understand some actual conversion is used, actual rate conversion is used in some of the points like HO account. See, HO account will appear in the books of branch. Similarly, branch account will appear in books of HO. Now, our HO is in India. So, it will be having a branch balance in rupees. So, how to convert HO accounts in the books of branch? Don't use any rate, directly see this figure. What is rupees figure in HO's books as far as branch account is concerned? That should be HO account in the books of branch in terms of rupees. So say HO account in the books of branch is $10,000. And in the books of HO in India, branch account is 8 lakhs rupees. So, how I will convert this $10,000? I will directly write down 8 lakhs rupees. So, I will be using 80 rupees per dollar rate. Again, goods sent to HO. Goods sent to branch, or in reverse, goods sent to HO. It will be also recorded at actual rates or actual figures. See, when goods are sent by HO to branch, HO will be recording at rupees, branch will be recording in dollars. That figure which HO has recorded in rupees, that should be converted for this particular figure. So, HO account in the books of branch and goods are sent to branch, these two figures will be recorded at actual rates.